A very good morning to all of you students. My name is Siyadus Gupta, and today we will be continuing on the topic of mergers and acquisitions. And post that we will be concluding our sessions with the topic of startup finance. So students, let's start with question number 19 first. So this is so both the questions, question number 19 and 20th, which are two questions of the today's class, are very unique questions in the way these similar sort of cases are very different from the ones that we have discussed till now. So coming to question number 19, the following information is related to Fortune India Limited having two divisions, viz. Pharma division and fast moving consumer goods division. So first of all, they have mentioned a company which has two different divisions, FMCG and Pharma. Paid up share capital of Fortune India Limited is consisting of 3,000 lakhs equity shares of rupee 1 each. So these are the numbers into face value of rupee 1 each. Fortune India Limited decided to demerge. So this is a question of demerge students. Demerge Pharma division as Fortune Pharma Limited with effect from 1st of April 2009. Details of Fortune India Limited as on 31st of March 2009, that is one day prior to the demerger, and of Fortune Pharma Limited after demerger is as given below. So Fortune India is the total balance sheet and this is the split balance sheet, right? Fortune Pharma. Now, outside liabilities, they've mentioned secured loans, unsecured loans, current liabilities, and provisions. Assets, they have put it down as fixed assets, investments, current assets, loans and advances, and deferred tax miscellaneous expenses. Board of directors of the company have decided to issue necessary equity shares of Fortune Pharma Limited, which is the new company, of rupee 1 each without any consideration to the shareholders of Fortune India Limited. Now, why this will happen? Why they will issue fresh equity shares of the new company to the existing shareholders? Reason being, they have given up certain part of their assets and liabilities, which is net assets, to the new company, and they should be compensated for whatever they have given up to the new company, right, in the form of shares. That is what they are doing. For that purpose, following points are to be considered. Transfer of liabilities and assets at book value. Okay, there is no revaluation that is going to happen. Estimated profit for the year 2009-10, which is the next year, is 11,400 lakhs for Fortune India Limited and 1470 lakhs for Fortune Pharma Limited. Okay, so both the companies, they have given that if Fortune India Limited after demerger continues, it will earn this much, and Fortune Pharma will earn 1470. Estimated market price of Fortune Pharma Limited is 24.5 rupees per share. Okay, this is the new company. Average P ratio of FMCG sector is 42 and pharma sector is 25, which is expected to be for both the companies. Now, after demerger, the company of Fortune India Limited will be carrying the business of only FMCG. Hence, the P ratio of only FMCG will apply. Calculate the ratio in which shares of the Fortune Pharma are to be issued to the shareholders of Fortune India. So first of all, they're asking us to calculate that ratio. Expected market price of Fortune India, which is the FMCG company, for that. Book value per share of both the companies after the demerger. What is their book value after demerger? Okay, we can calculate that. So let's first understand this better. So here is the total business of Fortune India Limited. Okay, now in this Fortune India Limited, there is a demerger, right? There is a split that has happened, one into pharma and second into FMCG, right? These are the two different businesses that the company was doing, right? India Limited, right? This was the entire company, Fortune India Limited. Now let's suppose the overall, I'm just taking a hypothetical example. Let's suppose their overall value of this company is 1200 crore, right? So maybe 1000 crore is attributed to this and 200 crore is attributed to this. Correct? Clear? So these are the different ways to see. Okay. So the 1200 crore of, let's say, value of these two businesses is split it into FMCG and pharma. And the company which is existing, which is Fortune India Limited. And there is a new company that got formed for this, which is called as the Fortune Pharma Limited, right? Now, since shareholders of Fortune India Limited has foregone their rights into this 200 crore worth of business, hence they will be issued the equity shares of this company. I hope you're able to make it out. Why are we issuing the shares of the new company to the shareholders? Right? To these people, the shares will be issued. Okay, so that they can make it up for the loss of their share in the pharma business. Now let's start our solution, students. So let's talk about Fortune India Limited first. So for Fortune India Limited, how many number of shares are there? If we want to first of all see that to which all shareholders we will have to issue, we have the number of shares as 3000 lakhs. These are number of shares, right? Then for Fortune Pharma, right? So what is their market price per share? 24.50, right? This is what is quoted, their market price. Their PE ratio is 25. That means their earnings per share is how much? Earnings per share will be market price per share divided by the PE ratio, MPS divided by P ratio. So 24.50 divided by 25. Yes, very good, Saminathan. 0.98 per share. So EPS is 0.98 per share. Now, if 0.98 per share is the earnings per share and their overall profitability is 1470, right? Can we calculate the number of shares? The answer is yes. By dividing them, profits for Fortune Pharma 1470 lakhs, right? Number of shares divided by 0.98, 1500 lakhs. So these are the number of shares. Yes, Saminathan, answer is right. So 1500 lakhs is the number of shares that will be existing for Fortune Pharma Limited, the new company. Hence, the ratio is 1500 lakh shares for 3000 lakh shares, right? So 0.5 is to 1. Hence, the ratio is 0.5 is to 1, which is calculated as 1500 lakhs divided by 3000 lakhs. That is 0.5 share of Fortune Pharma Limited for 1 share of Fortune India Limited. Clear? So this is how we have calculated the number of shares. We'll move to the second part. The second part is about the expected market share of the existing company, which is Fortune India Limited. We have been given PE ratio. If we calculate the EPS, we can calculate the market price, right? Expected market price for Fortune India Limited. Yeah. Estimated profits 11,400 lakhs, right? Divided by number of shares. We all know that it is 3,000 lakhs. This is for the existing company, right? Which is continuing the FMCG business. EPS is 11,400 lakhs divided by 3,000 lakhs, right? So this becomes 3.8 per share. Estimated PE ratio estimated PE ratio is given as 42 students, right?
Yes, sir.
Yeah. 42. So that means MPS, market price per share, is equal to 42 into, yes, very good, Saminathan, 3.8, which is 159.60 per share. So this becomes the market price per share, expected market price per share of the FMCG company, which is Fortune India Limited. And then lastly, what is their respective book values is what we will compute now. Yeah. Book values. Computation of book values. B and A minus B. How come we are writing A is actually the Fortune India before demerger? Because this is what it is given to us. then Fortune Pharma. This is after demerger, that is also given to us. And then the difference between both of them will give us the Fortune India Limited, only the FMCG business after demerger. Fortune India after demerger. A, B and A minus B. Okay. Their total assets from here till here. Let's do the total. 7740 till the miscellaneous expenses also. This is 7740, 7600 plus 8800 plus 900 plus 60. This is for Fortune Pharma Limited, 25,100. And then Fortune India Limited is 20,400 plus 12,300 plus 30,200 plus 7,300 minus 200. Yeah, so 70,000. Yes, Saminathan, you are correct. So assets, total of all assets. Here it is 70,000 and here it is 25,100. Okay. And then the difference between these two will be the Fortune India Limited after demerger, which is 44,900. Liabilities. Liabilities is 28 and 13. $4,100 is for Fortune Pharma, and this is 22 plus 3, 25,000. Yes, Aminathan, you're right. 25,000 for Fortune India. So 25,000, 4,100. Okay. The net book value. Okay, first of all, the liabilities for Fortune India after demerger will be 20,900. Right? This is just the difference between both of them. Net book value. This is going to be 45,000. And we can mention here this is rupees in lakhs. Okay. Because all of this calculation is in lakhs. Then 25,100 minus 4,100. This is 21,000. Then 44,900 minus 2,900. So this is 24,000. Yes, very good, Saminathan. The answers are correct. Then the number of shares, students. 3,000, 1,500, and again 3,000, right? These are the three different number of shares. So book value per share. 45,000 divided by 3,000, 15. 21,000 divided by 1,500, 14. and 24,000 divided by 3,000 is 8 students. So these are the respective book values per share of all the three situations put together before demerger and after demerger of both the companies. Okay. Clear, students?
Yes, sir.
Perfect. So this was a peculiar question on demerger. Okay. Because till now we have discussed about all the merger cases, but demerger is also relatively simple, wherein you will have to calculate that what is the value, or let's say the shares to be issued to the existing shareholders so that they are compensated for their business that they have transferred to the new entity, right? For that they need compensation. Perfect. Then let's come to question number 20, students. Okay. So question number 20 is, during the audit of weak bank, RBI has suggested that the bank should either merge with another bank or may close down. Strong Bank has submitted a proposal of merger with Weak Bank itself. So they have submitted a proposal for the merger. Okay, the relevant information and balance sheets of both the companies are as under: Weak Bank, Strong Bank, and assigned weights. What is their respective gross NPA? So if you see, the gross NPA is a negative KPI, right? The key performance indicator is negative. Higher it is, it's not good for the bank. So this weak bank is having 40 percentage of their loans and advances as NPAs, which is not a good indication. However, strong bank is only having 5. Okay. Capital adequacy ratio 5 and 16. That means how much your capital is adequate to fund your overall assets. Total capital divided by the risk weighted assets, which is this one only. The formula is capital adequacy ratio. Okay. Then market price per share is 12.96 and the assigned weights is 32. Book value trading on stock exchange, irregular and frequent. The book value is given as 10%, right? They have not given us the respective values, but they are saying 10%. So this total, if we do 28 plus 32 is 60 and 40, 100. So the total assigned weights is 100, for which we have to compute the swap ratio, right? Because this is their assigned weights that they have given. Let's see. Then the balance sheets. For weak bank and strong bank, what is their paid up share capital, reserves and surplus, deposits, and other liabilities? Similarly, their cash in hand, balance with other banks, advances, other assets, and preliminary assets, and the total. Right? So we have been given their respective balance sheets. Okay. You're required to calculate the swap ratio based on the above weights. So the weights are this, and we will have to calculate the swap ratio. That is fine. Second, ascertain the number of shares to be issued to weak bank. After calculating the swap ratio, we can very much do that. Then third, prepare balance sheet after merger. They are asking us to prepare the balance sheet as well. That we will do, and calculate CAR and gross NP of the strong bank after merger, which is nothing but their respective values multiplied by these basically specific amounts. Okay, so we will come to that, how to calculate that. So let's first start with the swap ratio calculation. Let's come to solution, students. The calculation of swap ratio. Okay, there are 4 different criterias. Let's first talk about basis, gross NPA percentage, right? Now the formulas that we have discussed till now is the target company is always in the numerator and acquiring company is in the denominator. But in this case, since it's a negative ratio, the order will be reversed, right? This is what we have discussed in the beginning of the first session of mergers and acquisitions. That because of this gross NPA, the formula will look like as this: NPA percentage of acquiring company divided by NPA percentage of target company, right? Which is 5 divided by 40. Okay. This is the first ratio. And the second ratio is capital adequacy ratio. This will also get calculated in the similar way, capital adequacy ratio, students, which is capital adequacy ratio of target company divided by capital adequacy ratio of acquiring company, right? So this is how much? 5 and 16. 5 divided by 16, or we can say weak bank and strong bank, right? That's what they are referring to here also. This will be strong bank and here it will be weak bank. Only in case of NPA it will get reversed. Okay. So this is the second ratio, students. The third one is basis market price. Basis market price per share. So market price per share of weak bank divided by market price per share of strong bank. Okay. Which is actually 12 by 96. And the last one is actually the book value per share that we will have to compute. So let's compute the book value per share, students. But let's write the formulas yet. BVPS of weak bank, BVPS of strong bank. Okay. Now calculation of book value per share. So this is the weak bank and this is the strong bank. Okay. Now paid up share capital 150 and 500. This is given in the question. Then we will add back the reserves and surplus. So there are two ways to calculate, right? Either we can take the net assets value or we can go from the equity and share capital value itself, right? So equity plus reserves and surplus, which is 80 here and here it was 5500. Okay. Then minus preliminary expenses, right? Minus preliminary expenses. So this is minus 50 and dash. right? Then the total book value. So the total book value is 180 and 6,000, right? So 5,000 and 5,500, 6,000. This one is 150 plus 30 is equal to 180 divided by number of shares. How can we calculate the number of shares, students? We have been given that the 10 per share is the paid up share capital, right? 10 per share is the paid up share capital. So that means 150 and 500, if we divide it by 10, we'll get the number of shares. 150 divided by 10 and 500 divided by 10. This is 15 and this is 50. Yes. So what we have done here, paid up share capital divided by value per share. Okay. The book value per share becomes how much? So 15 divided by 180 divided by 15, right? And 6,000 divided by 50. So this is actually 120 and this is 12. Clear? So 12 and 120. Ultimately, we will have here as 12 divided by 120. Refer calculation below. Okay. So we will get 12 divided by 120. This is their book value per share, students. Any doubts, any question till now, students? Perfect. Then comes the calculation of overall swap ratio, right? Basis their respective weights. Calculation of overall swap ratio, right? So the ratio is what we will put here. We will put the basis here. What is the basis at which the ratio is calculated? Their weights and the weighted ratio, right? The first one, gross NPA 5:40, weight is 30%, 0.0375, right? 5:40 was the first one and 30% weight is given. We have just multiplied it. The second one is capital adequacy ratio 5:16. 28% was the weight. Yes. So 0.035, how we have calculated is 5/40 into 0.30. Okay, this is how we have calculated. Then 5:16 for 28% of the weight. How much we have? 5 divided by 16 into 0.28. This is 0.0875. Third one, right? Yes, Saminathan, you're right. Then market price per share is 12:96, 32%. So this is 12 by 96 into 0.32. So this comes as 0.04. Yes, Saminathan, you're right. Then the last one is book value per share 12:120. 10%, and here also 12 divided by 120 into 0.10. So this comes as 0.01. Right. So if we add all of them, which is 0.0375, 0.0875, 0.04, 0.01, we will arrive at 0.1750 is to 1. Okay. This is the summation. Clear? The second part now, students. Okay, clear? So the swap ratio is 0.1750 for one share of weak bank. Okay. The second part is now ascertain the number of shares to be issued to weak bank. That's quite easy. Number of shares to be issued by strong bank to the shareholders of weak bank. 150 divided by 10, right? 150 divided by 10 is the number of shares of the weak bank multiplied by 0.1750, which is equal to 2.625 lakh shares. Yes, very good, Saminathan. So these are the number of shares that will be issued to the weak bank's shareholders. Now the last one, we will have to prepare a balance sheet of the strong bank after merger. So for that, we first need to calculate that what is the book value of the assets that we are taking over, what is the consideration that we are paying it to them, and what is the net goodwill or capital reserve, right? Because while purchasing the weak bank, we will end up either paying extra or paying less against the assets that we are receiving, right? So let's do that. Book value of weak bank. We will take it from the above, which is 180, right? This one. So if 180 is the book value of the weak bank minus issue of shares through which we will be paying the consideration is how much? This is going to be 2.625 lakhs multiplied by 10, right? So 26.25 lakhs is the number of is the amount of consideration that will be paid. Now you see, students, 180 is something that we are receiving and 26.25 is something that we are paying. So that means we are getting 153.75 lakh rupees of extra assets as capital reserve. Okay, this is something extra that we are getting in the form of a capital reserve. Perfect. Then let's come to their balance sheet now of strong bank after merger. Yes, this is as per NDS 103, which is the capital reserve or goodwill. Okay, rupees in lakhs. Particulars. So this is first of all the liabilities, equities and liabilities side. Okay. So in this, the paid up share capital was 500 plus 26.25 is the new shares that they have issued, right? Of the strong bank to the weak bank. So this becomes 526.25 lakhs, right? We have already mentioned above rupees in lakhs. So this is the paid up share capital. Reserves and surplus will continue to be for the strong bank, which is 5500, right? It will not get added. Reserves will never get added, right? Reserves will remain for the acquiring company itself. So the reserves and surplus is 5500. After that, we will also put capital reserve, which is the new one, right? Capital reserve was 153.75. Correct? The new one that has come out, which is this one. Then deposits. The deposits will get totaled, right? Because it's a outside liability. So 4,000 plus 4,400, 48,000. Sorry, 4,000 plus 44, right? So in totality, 48. Sorry. Okay, 48,000. Then there are other liabilities. Other liabilities 890 and 2,500, which is 3,390. Eight ninety plus 2,500. Okay, this is 3,390. So this becomes the equities and liabilities part. If we total it out, it becomes 57,570. Right? This is done. Then let's come to the assets side. So in terms of assets, we will start with cash in hand and with RBI, keeping the nomenclature same, right, to what it is given in the question. This is 400 plus 2,500. So this becomes 2,900. Then becomes balance with other banks. This is how much? 0 plus 2,000, right? This is in totality 2,000. Okay, then investments. Investments is 1100 plus 19,000. So this is 20,100. These are the overall values of investments. Then advances. Yeah. Then comes to advances. Advances are 3,500 plus 27,000. So this becomes 30,500. Then other assets is 70 plus 2,000. This becomes 2070, the value of other assets, and hence the total assets, if we do it now, we will not take over the preliminary expenses, right? This is something that we are not taking over, right? Because you don't, this is in the nature of unadjusted expenses, right? That will get adjusted with the reserves and surplus. In the calculation also, we have adjusted it, right? So we will not be taking it ahead. So the total assets comes out to be 57,570. Yes, perfect. So this 57,570, this is the total, and here also it is the total assets, right? So the balance sheet is crafted. We have the balance sheet with us now, okay, for all the assets and liabilities. So the concept is very simple and easy, students. In case of a balance sheet of a merger and acquisitions, right? First, we need to calculate what is the goodwill slash capital reserve, right? Have we purchased it on premium? The goodwill would have come. Had we purchased it on discount, the capital reserve has come. For example, instead of 26.25, we would have, let's say, issued 200 worth of shares. Then the extra amount of 20 that we have paid would have represented goodwill. Okay, not capital reserve. Let's come to the last part of the question. Calculate the CAR and gross NPA of strong bank after merger. CAR and gross NPA of bank after merger. So what is the, sorry, if purchase consideration is less than book value, no, fair value. It should not be book value, it's fair value as per the standard. Okay. Here in case of the merger, we are assuming fair value is equal to book value. But practically it is always fair value. Yeah. Okay. Yes. Net assets value. Yeah. Okay. And then capital adequacy ratio is equal to total capital divided by risk weighted assets. So this is the ratio, students. Now we'll have to compute how to calculate this. Let's come to weak bank, strong bank, and the merged bank, right? 5%, 16%. Correct. This was the CAR ratio of them. What was their total capital? 180 and 6,000, right? This was the computed value. In step 2 we have in step 1 itself we have calculated this, that what is the respective values of capital. Risk weighted assets is, that means it will be 180 divided by 5%, right? That is 3600. And similarly here it will be 6000 divided by 16%. So this will be 37,500. And then the merged entity capital is something that we will recompute. The percentage is then outcome, but we can just simply take the risk weighted assets total, which is 37,500 plus 3600, which is 41,100. Yeah. And this comes out to be 41,100. Now let's calculate the capital adequacy ratio for combined entity. Okay. What is their total capital divided by risk weighted assets? So what is their total capital? For the new entity, we just now have created the balance sheet. All these three values put together becomes their total capital, right? 526.25 plus 5500 plus 153.75 whole divided by 41,100, right? Which comes out to be 15.04%, right? So this is the capital adequacy ratio for combined entity. Capital adequacy ratio for combined entity is 15.04%. Then the second part is the gross NPA percentage after merger. Weak bank, strong bank, and the merged entity. Sorry. So the gross NPA percentage for weak bank was 0.40 and strong bank was 0.05. Correct? What is their advances? So students, the gross NPA is always calculated on advances. What we have given, right? So 3,500 and 27,000 is the value of their advances. Yes, loan given by them. Correct. So this becomes 3,500 and this becomes 27,000. These are the advances, and in totality it becomes 30,500. Okay. Then let's come to gross NPA. Okay. Saminathan is saying last week we studied these provisioning for bank and auditing classes. Yes, for the from topic of bank audits, right? Okay. So these are the advances. Now, what is the gross NPA absolute amounts? 3,500 into 0.40. Similarly, 27,000 into 0.05. So this comes out to be 1350, 1400, and hence the overall is 2750. Right? This is the overall value that comes out to be the value of the merged entity, and hence the gross NPA percentage is equal to 2750 divided by 30,500 into 100, which is equal to 9.01 percentage. Yes, Saminathan, you're right. So the gross NPA percentage comes out to be 9.01 percentage. Any questions, any clarifications or queries, students? Okay, Saminathan is saying 9.016, so let's make it as 9.02. Okay. Clear, students? So this was also one of the specific question on how the banks related, let's say some of the metrics are tracked, for example, capital adequacy ratio, gross NPA, and how it plays a role in the overall mergers and acquisitions. Anything? No. Okay, perfect. Then let's move ahead, students. So with this, we have covered all the practical aspects of mergers and acquisitions, right? In our previous session, we have also covered some of the theoretical part, which included what is the rationale for mergers and acquisitions. The biggest rationale was synergy. Then, obviously, the diversification of the risks, right? Why synergy? Because synergy will give you over and above benefits of whatever is their combined benefits, right? Whatever is their standalone benefits, if we put them together, the combined benefit will always outgrow them. And the reason being that there are some added cost structures, there are some overheads, there is some market advantage that they will get because of the mergers and acquisitions. Then diversification of the risk, students, we discussed that the unsystematic risk can be diversified, right? How? By entering into unrelated businesses that will drive their overall unsystematic risk to be lower. That is also one of the rationale for mergers and acquisitions. The third one was from the taxation point of view, wherein we know that since tax will be lower, right? For example, there is a company in which there are unabsorbed losses and accumulated depreciation sitting, right? That can be set off against the future profits, but this company is not going to generate any future profits. It is identified by a strong company which takes over the weak company, and hence they can adjust the accumulated losses with the profits that these companies are generating. Okay, so accordingly, even the valuation of the weak company will be according to this method itself. Okay, wherein they will be actually only doing the calculation that how much benefit that they will get in the tax, and accordingly they will calculate the valuation of the entity. Then the fourth part is on the growth, right? If they want to let's say have a better growth, right, in terms of the organic and inorganic, so the inorganic growth will also lead to the year on year better growth from the perspective of the acquiring company. Clear? So then let's go to consolidation, the last part. Why the merger and acquisition is happening? Because of the consolidation of production capacities and the increasing market power. This also we have discussed today. And then we discussed about the types and forms of M&A, right? What are the different types and forms of M&A? The first type and form is horizontal merger, where the merger happens between the competitors which are part of the same industry, right? They are parallelly, so let's say they are peers to each other, right? Then vertical merger. In vertical merger, either a customer gets integrated or a vendor gets integrated into the business. The customer gets integrated, this is called as the forward integration. If the vendor gets integrated, this is called as the backward integration. And this entire chain is called as the vertical merger. So if the merger happens between the entities which have a buyer-seller relationship, that is called as a vertical merger. Then comes the conglomerate merger, students. Conglomerate merger is the merger where the two unrelated entities, right, merge and they carry on the business which are totally unrelated in terms of the nature of the business, right? Then the co-generic merger, we said that their genre is similar. For example, either they belong to the same industry or they have a common distribution channel, somewhat product line is similar, so that's what it contributes to the co-generic merger. We discussed about the specific case of NBFCs, one giving auto loan and second giving the credit card. So we said that both of them are into the business of lending money, right, or providing money. Hence, we said that if both of these companies, NBFCs, merge together, that is called as the co-generic merger. Then this one was important, which is the reverse merger. In case of a reverse merger, generally what happens, a large company acquires a smaller company, but here what happens, a private company takes over a large public company. This large public company is listed, so what happens through this takeover, even the private companies also gets listed. Okay, then comes the acquisition part, in which we purchase the majority stake or we start controlling the board of directors, using which it is calculated as the acquisition part of the mergers and acquisitions. Now let's come to the next part. This is called as divestiture. Divestiture means where you bring down your stakes, which is, let's say, selling assets or group of assets, or let's say even the business unit. First one, sell off, or partial sell off. Okay. In this, what happens? Some part of the entity's assets are sold off. or partially we are selling a business, right? This is also called, this happens in the name of slump sale of businesses. Okay, this is called as sell off. Second, spin off. So sell off is just simply selling your assets or business. Spin off means that, let's say you have in a single entity, again you have two things. One is business 1 and business 2. So business 1 remains in A Limited, the business 2 gets transferred to B Limited. The similar case of Fortune India Limited and Fortune Pharma Limited, the one that we have discussed, that is called as spin-off. So by selling one of the businesses to the new entity, that is called as the spin-off. Clear? So we are spinning the business off into a new entity. Quickly, the difference between sell off and spin off is what? Sell off is you just sell to a outsider of the business, right? In spin off, you still create a new entity within your own group and you transfer that business to a new entity. That is called a spin off. Third, split up. Yes, it's like a demerger, Sanjay. Yes. Spin-off is demerger itself. Okay. Split up. Now, split up will mean that there is an entity called A. It gets splitted up into different companies. And A is dissolved. The legal entity status of A gets dissolved. It's no more there, and it gets split up into multiple entities, which will become the entities for the future. Is spin-off to related party, then related party transaction, there is separate accounting only at book value, not at fair value. Yes, this is called as common control transaction, Saminathan. Index 103 Appendix C. Yes. Okay. But this is relevant from accounting standpoint. Common control business transaction is a transaction where you sell your business slash assets. No, not assets, only business. Where you transfer your business to a new entity and the new entity is also part of the similar group that you are, right? So that is happening at book value in this case, not at the fair value, the accounting wise. So this is Ind AS 103 Appendix C. Okay. Okay. Then comes the split up part. Yeah, split up part we have discussed, students. So in split up, we are splitting up an existing company into multiple companies and the existing company gets dissolved. Fourth part, equity carve out. So in this case, what is happening? Equity carve out means that first there is a spin off that happens. Right? Spin off has happened. That means we have transferred the business to the new entity. Plus, apart from that, we also issue new equity shares in the market. These two things happens together. It is called as equity carve out. That means you are spinning off your business. At the same time, you are issuing new equity shares in the market. That is called as the equity carve out. And the last one is actually the demerger. slash division of family managed businesses. So for this, we have many real life example students, right? Where you would have seen that the family managed business is getting split. One part is basically taken over by one part of the family, and the second business is taken over by the second part of the family. In this case, there are different arrangements will get triggered, and there are different ways of doing this, right? Either to change the at the holding level, the or let's say to make two different holding companies of the two different groups that will get split up, right? And then ultimately handing over those holding companies to those respective shareholders or the family setups. Okay, so it will involve series of changes in the overall scheme of things. Okay, perfect. Now let's talk about financial restructuring. So financial restructuring means a structuring where you tend to change the financial ways of working of a company, right? And where it is needed, first of all, it is needed for a sick company. A sick company is a company which has accumulated losses, right? Huge debt with no cash inflows. They have negative net worth. I mean, financially, they are not at all viable to be continued. Those are called as the sick companies. Okay. For these sick companies, there is a plan to revive. How? So, first, equity shareholders are requested to forego, let's say, some part of their paid up share capital as a part of the financial restructuring program. For example, 10 rupees is the paid up capital, and 5 rupees is what they will say that okay, from now onwards, because of this financial restructuring, your 5 rupees paid up share capital gets forfeited, and you will be only eligible for the balance 5 rupees of paid up share capital. Clear? Second is on loans slash borrowings. Okay, so let's say 10% was the rate of interest. They will be approached to make the rate of interest as 7% because of the financial difficulties. They will be asked to lower the rate of interest for which they have given the loan to the company. Then it will also be shown as convertible into equity. So the debt repayments will get converted to equity. Reason being, if this gets converted into equity, the immediate cash outflows are not required to be paid, right? They can still be paid after some time. Yes, interest portion we have already discussed. From 10% to 7%, it can be avoided to the extent of 3%. Okay. And okay, you are saying if we directly convert into the equity share capital, yes, the percentage interest will also be avoided. You will even save the cash flows on the percentage of interest. Yes, Saminathan. Then working capital. With your debtors, you'll ask them to pay early. And with your creditors, you will ask for more credit so that you can pay them after some time. So capital, okay, so we'll ask for more credit from vendors and collect on time from customers, right? Yes, getting some ad hoc limits. So this is what all about the financial restructuring relates to, right? In which you're trying to re-engineer or let's say reconstruct the financial aspects of the company through some of these negotiations slash changes in the financial ways of working. Then comes the ownership restructuring. What do we mean by ownership restructuring? One, going private. So Sanjay is asking, why would suppliers give extra credit to a sick company? We are not talking about the fresh purchases. We are talking about the existing payments that we are supposed to make to them, right? Even for that matter, so there will be a renegotiation that will happen with all of them. For example, why will even a borrower or let's say the person who has given loan to a sick company would agree to make from 10% to 7%? Because then we can just simply tell them that the company is on the verge of bankruptcy. If it happens, nothing will be payable, nothing will become recoverable to any one of the creditors slash the lenders, right? And hence, this is a financial restructuring plan where we are trying to save through some of the kitties through each and every one cuts, and hence we will be able to start afresh. Okay, so this is part of their overall negotiation. Then comes ownership restructuring. The first one is going private. So going private means that, so one is going public. Going public means that we're issuing equity shares to the public. Going private means that you are buying back your shares from the public. Buy back shares from market to become private. Okay. So this is actually going private. Second, management buyout. This is called as MBO, wherein the management itself becomes the shareholders of the company by buying the majority stake in the company, right? That is called as the management buyout. Third one, leveraged buyout. In this case, the buyout happens through borrowing the money. So first you borrow, borrowing taken, and then you invest by discharging the purchase consideration is discharged. Clear? So here you're doing what? You're just taking the borrowings first and then you're discharging the purchase considerations. The last one is called as equity buyback. Right? So the equity buyback happens where you just buy back some part of your equity from the public. right? So that your, let's say, equity in float becomes lower. Okay. Clear, students? These are the different forms of ownership restructuring: going private, management buyout, leveraged buyout, and then equity buyback. Perfect. Then comes special purpose acquisition companies. So these are new forms of companies, SPACs. This is called as SPAC, special purpose acquisition company. Now, what is their fundamental things to do? One, they bring IPO, which is initial public offer. They will raise the funds from public at large. Okay. Through this IPO, they will raise funds from public at large, and then they will keep that funds into a trust or through an escrow account. They are keeping it into the trust in the form of an, or let's say in the form of escrow account, right? That means they will not be using it directly. These are all proceeds from IPO, and they will do this after they have launched the IPO. Then what will happen? What they will do after keeping the money in trust or escrow account? For next 2 to 3 years, they will look out for a target company. So that means their primary focus is to look out for a company which is a good to acquire company. Then, before finalizing the deal, approval from majority shareholders is required. So this is one. So let's say they have identified a target company called A Limited. Then SPAC company cannot just directly go and invest into that company. They will have to, before finalizing the deal, they will have to require the approval from the majority shareholders that this is the new company that we have identified, and in this we are going to invest. Second, till the time deal is finalized, money is kept in an escrow account or trust. Till the time deal is finalized, money is kept in escrow account or fund, right? Or trust, basically. Then there is a proper due diligence that happens before we acquire the target company. And once everything is complete, the money will get released and it will get invested into the target company. So this SPAC is also called as blank check companies. Okay. These are also called as blank check companies, in which That means shareholders are investing, but they don't know for which purpose the funds will be utilized, right? That is called as the blank check. It is the situation similar to blank check, wherein you are investing into a company, but you never know what will be the end result of that money that you have invested. It might get 2 to 3 years to a stage wherein you will be able to invest into that company, students. Clear? Everything is clear, students? Any questions or any doubt, please do let me know. Okay, let me check the query
Sir,
handle. Well,
are,
yes,
are these are these special purpose acquisition companies existing companies or they are newly formed and then they go for IPO?
it can be both, but the thing is, generally they register themselves new because they they don't want to mix the complexity of any existing business and at the same time going through as a special purpose acquisition company also, right? So their nature is only special purpose acquisition company, and hence they generally form a new company to do this venture.
Okay, okay, right.
No. So there is a good question from Bibu Pandey. But in India, if company is not in operation, it will be shut down by registrar. No, it will not be the case because registrar will be informed. Okay, while filing the IPO in India, you will inform to the shareholders that this is a special purpose acquisition company. It's not that for 2 to 3 years the company is not operating. The company is operating, and the nature of operation is to find out a target company. That is what the operation is, right? So it will not be closed down by the registrar, and even the intimation will also go to the registrar that it will be issuing IPO and the amount will be kept in escrow account or trust till the time they find out a suitable target. Okay. Yes, it is allowed in India. It is allowed in India. And let me tell you, this is a very matured concept in the Western world. Let's say US and Europe, this is a very matured concept where they have been doing this, right? But India also it is allowed. Okay. Okay, then students, quickly let's break for 10 to 12 minutes, then again reconvene and cover up the startup finance. Friends, let's start with the topic of startup finance. Yeah, we're just checking the queries. Let's start with the startup finance. So, startup finance is a separate topic in advanced financial management. It deals with the concept of startup and different ways or sources of finance available to finance the startup. So let's first understand what is meant by the startup. So the startup is first of all a private limited company or registered partnership firm or limited liability partnership LLP. We call it as LLP, right? So these should be some of the legal forms of startup. Actually, this definition is given by the government of India through one of the notifications. So what they're trying to do, they're trying to eliminate any sole proprietorship to be called as startup. Reason being, it's very simple that it has to be in the form of an organized legal entity, which has to be separately registered in the form of a partnership firm, limited liability partnership, or private limited company. Second, it will be called a new venture will be called as a startup if it is in the first 10 years of incorporation. Of incorporation. So ultimately 0 to 10 years, anywhere in between, if the company is there, it will be startup. If it has gone to the 11th year of operation, it will not be called as startup. Okay. Reason being simple, because 11th year the company is now matured. It cannot be regarded as startup. Third, turnover up to 100 crores. So if the turnover crosses 100 crore, then it will not be a startup because it has become already scalable business. It has already become a big business. So only up to 100 crore should be the turnover for the business to qualify as a startup business. Then it should not form through split up or reconstruction of existing business. So, for example, today we discussed about Fortune India and Fortune Pharma. If let's say Fortune Pharma is formed after split up or reconstruction of the existing business, we cannot say that the Fortune Pharma is a startup because it's not a new venture, it's just formed by a split up. Okay, so the important condition for it to be satisfied is that it should be a new business students. Then the last point, just a second, is on the innovation develop or improve. Now, these are the core. These are at the core of any startup, that either they are innovating something, either they are developing something, or they are improving something. What? A sort of a product, or even a process, or even a service for that matter, right? Which is actually scalable, and it leads to wealth generation and employment opportunities. So, student, they're trying to say that the startup should do something meaningful, right? It's not that okay, you have just opened a trading company and you'll be called as a startup, wherein you are purchasing and selling goods. That's all, right? Or let's say you've just opened up a restaurant, you will be called as a startup. No, for qualifying to be startup, you need to make use of, let's say, the advanced level of science, or let's say some new level of technique to innovate, develop, or improve any of the product, process, or services. Okay, perfect. Now, this is the meaning of startup, students, right? So first of all, if you are a startup, and for being a startup, you need to satisfy these 1 to 5 conditions, and then you will be accordingly be called as the startup, and then you will be eligible for other things, right? Other benefits. Now, innovative ways to finance a startup. So if the question comes, right, what are the innovative ways to finance a startup? We will have to write all these points, right? Because the way study material is drafted, there are different headings of, or there are different ways to finance a startup. The innovative ways to finance a startup are these. One, personal financing. So personal financing means that you have personal ways of financing your business, because you are, let's say, the one of the partners. So you are bringing in your personal financial related aspects to the business, right, by which you are helping the startups to grow. So that means it is more closely linked with the founder of that startup. Second, personal credit line. That means you are actually making use of your personal credit cards to fund your startup payments, for example. Okay. Then friends and families. So friends and family means that you are seeking their help in terms of the loans to be taken from friends slash families, and utilize those loans to finance your startup. Because today, if you go to a bank, right, the bank might charge you a very high rate of interest, or the bank might not agree to give you a loan because there is no activity set up as such. So using these small sources of finance, which is personal financing, personal credit line, and friends and families, you will be able to at least start the initial part of the business. And then for friends and family, sometimes you end up paying interest, and sometimes you end up paying lower interest in the market compared to the market, right? So this is the benefit of friends and families. Then comes peer-to-peer lending. Now, let's say there are 3-4 different startups, and there are 3-4 different founders, and there is a one founder each of that startup, and all of them are connected. Now, they all know what are the financing needs of the other startups. And then, if between them, amongst themselves, right, amongst 3 to 4 startups, they fund each other, right, in the need that they will in the need, when it will arise, they will give the loan. When, let's say, the cash flow is there, then they will repay it back, right? So this is called as peer-to-peer lending, where there is a specific group of people who amongst themselves give and take the loans, right? And they repay them back. Fifth one, crowdfunding students. So the crowdfunding means that you are sourcing your borrowings or you are sourcing your funds from the crowd at large. Okay? Crowd at large means that, for example, there are different platforms, right? On these platforms, different individuals, small individuals will be registered as investors, right? Who can invest, let's say, a minimum of 10 rupees to, let's say, 10,000 to 10 lakhs, right? So there is no minimum amount. You can go as low as a very small amount, and these are n number of platforms. Then the listed businesses are startups here. They are also listed here. They are in the need of money, and these small individuals will select or pick some of the startups in where they want to invest, right? And it will give them a chance to invest into those startups through investing smaller amounts, correct? So this is called as crowdfunding because you are funding from crowd at large, investing smaller amounts into the startup, right? And then once the tenure of the borrowing is over, then the proceeds will go back from startup to the individual investors themselves. Okay, clear? So different startups will be listed which will have their different case studies on this platform. There are different pitch presentations on the platform which will tell them about the nature of the activity, name of the promoter, what is their overall vision, what are they going to do, what is the market size, all of those things, right? So this is called as crowdfunding. Then comes micro loans. So micro means small loans, right? Again, these will be approached to the banks and NBFCs wherein the nature and the intent of the loan will also be specified. What will happen through the end use or the end use of the loan will also be specified, and then they will be given a loan to scale up their business. Seventh, vendor financing. Let's say currently you enjoy a 30 days of credit period. You will approach them to take a 45 days of credit period. This is called as vendor financing. Okay. This is called as vendor financing. Wherein you are asking your vendors to extend your credit period and hence you are able to make better financing available with you. Purchase order financing. Now, once you receive a purchase order is a valid document which is a commercial document through which, let's say, some person has committed to the other person to purchase certain amount of volumes at certain price. Now, if let's say I am a supplier and I receive a purchase order, I will need funds to service that purchase order, because then only I will be able to make products at my end. So for that, the required amount of financing will come from the person who has given me the purchase order. So I will ask them, okay, can you give me an advance against this purchase order? Yes. Receive advance from customer against a PO. And that will help me to supply them through that advance, that is called as purchase order financing. This is coming from customer finance. Okay. And the ninth part is factoring account receivable. Yes, to purchase the raw material and so on. This was required for that angle. Then factoring account receivable means that you have a AR sitting in your books. AR means account receivable in the books. Then you do what? You go to a bank and you tell them, pay money now to me, and you realize the AR later on. Okay, so that means factoring means that you pay me the amount today itself after deducting, let's say, your commission, your discount charges, and then you directly receive the amounts after the time when it becomes due. Now it happens through two forms. One is recourse basis and second is non-recourse basis. Anyone would like to attempt what will mean by recourse and non-recourse? Anyone would like to call out? Yes, Saminathan has mentioned if AR is not paid, then company need to pay. That means the risk is not getting transferred. Risk is not transferred. Here the risk is transferred, right? So recourse basis is the basis in which the risk is not getting transferred. If tomorrow the debtor is not paying to the bank, we will have to pay to the bank. Okay. Non-recourse means.
I think in risk, recourse basis, risk is transferred in recourse basis, I think.
No. Recourse means that you will have a recourse. In case you are not being paid, then you will have a recourse to me, right? That means you can recourse the liability to me. I will pay it to you. That means risk is still with me, correct? Okay, let me just write it here. Let's say A Limited is the company which is having AR. Okay, accounts receivable. Then bank B is the bank which has done the factoring, and it is receivable from C Limited. This is the debtor. C Limited is the debtor, right? Now, if let's say bank B has already paid to A Limited, right, at the time of factoring, now C Limited will pay to bank B. If they don't pay, then in the case of recourse, bank B will ask A Limited to pay the amount. Okay. So the risk is with still bank A, with risk is with still company A Limited. This is the case of recourse. Okay. And non-recourse, if it is not paid, then even this will not be asked by the bank. Bank cannot ask it legally. Okay. That is where we say that the risk is transferred in case of a non-recourse from A Limited to bank B. The risk of collections. Okay.
Okay.
Perfect. So these are some of the ways of innovative ways to finance a startup. Okay. Then comes the concept of unicorn. Any idea to whom we call as unicorn?
I think the valuation is $1 billion.
Yes, true. So business valuation of that startup is $1 billion. If it crosses it, then it is called as unicorn. Okay. Then pitch presentation. We had touched upon this topic very briefly. Let's cover this topic in detail. What is meant by pitch presentation? So students, in case a startup is asking for money, just a second. Yeah, just a second. Yeah. So I was asking for pitch presentations, why first of all it is needed. So pitch presentation is basically used for those places where we are going to raise the funds, and for that you make a formal document with which you approach to the lender from whom you're getting the money, or let's say to the investor you are asking them to invest into your business. So generally what all things it will cover? It will cover a brief introduction about the promoter, right? The brief introduction about the startup, because if you see a startup, the face of the startup is actually the promoter. Okay. Then about the team, who all are part of the team, what is the problem that they have envisaged and they are working towards it, right? See, every startup, or let's say every business, will exist to solve for a problem. First of all, that problem statement has to be clearly defined. Then what is the solution that the startup is giving to solve for that problem? Correct? And then how they are going to market themselves, that is through marketing, and how they are going to increase their reach, distribution, penetration, that is through sales, right? So how they are going to do their marketing and sales, because this is a fundamental function while they have devised a solution. Then they will also have to come across that what is their projections about P&L, cash flow statements, right? Because as an investor, a investor would be interested to see that what is the amount of cash that they are generating, and of course their balance sheets, right? This is about their projections. Then what is the competition around their business, right? They will also include that with this in the industry, this is the competition. They will also tell in their pitch presentation what is the business model that they're resorting to and how they are going to arrange the financing part of it, and what is, let's say, their valuation of the business, right? So these are some of the major things that they will try to include in their pitch presentations, right? This is again part of your chapter, so you can cover that in detail, but it's a very simple and a basic thing. Assume you are a startup founder, then what all things you would want to include while you will pitch for any money, and you will get the similar sort of thoughts what it is mentioned. Then the next topic is modes of financing for startups. What are the different modes of financing for a startup? Number one, bootstrapping. So, bootstrapping means that making use of available resources that you have, right? How you can do that? One, through trade credit. Similar thing that we discussed, right? You go to the vendors, you approach them and tell them that instead of, let's say, 60 days or 30 days, you make our credit period to 90 days, right? So this is about increasing credit period. Then this is on trade credit, right? Yes, very good, Saminathan. Leasing is also there, and then factoring is also there. Factoring, and then C part is leasing. So factoring we discussed, right? Recourse and non-recourse. This is happening with customers, wherein you go to the customers and tell them that the where you take your AR to the banks and tell them to discount them and give them the values after discount, and the customer will pay back to the bank, right? This is called as factoring from the customer side, trade credit from vendor side, factoring from customer side, and then finally leasing. So leasing is the way wherein you rent the asset rather than buying the asset upfront, right? Renting of assets rather than buying them. Okay. So bootstrapping means that you make use of internally available resources, right, to finance the startup. So definitely trade credit is a small form of credit. Factoring is again a small form of credit. Both of them will give you working capital advantages, right? Both of them will help you in your working capital. Leasing will help you in your fixed assets sourcing, right? Because generally you will lease a capital asset, right? Then second is about the angel investors. Who are angel investor students? Angel investors are just like angel, right? They are high net worth individuals who would want to invest without any expectation of a return into a business, right? They just, let's say their behavior is just like an angel where they would want to help the budding entrepreneurs in terms of the businesses that they are doing. Okay. Yeah. Sanjay is saying like Warren Buffett. Okay. So these are the angel investors. Okay. So what happens in case of a startup? The angel investors can also be approached to fund, and generally they are known acquaintances within the family, right? Or let's say with these founders, they are the known people who will provide. Yes, they will provide more favorable terms compared to others. That's a good way to put it. Yes, Aminathan. Then the third is venture capital. What do we mean by venture capital? Now, this is something that we need to understand in detail, students. Okay, let's see. So good. Now, let me explain in detail what is venture capital. So, students, first of all, we know that what is meant by public equity, right? Public equity is a equity wherein public at large invest into an equity shares of a company, right? Public at large invests into a business. And since public at large is involved, we need to list it, right? List it on stock exchange. This gets listed on a stock exchange. This is called as the public equity. Now, on the contrary, what is called as private equity? A private equity will be an equity which is closely held, right? And it's in the form of a private company, correct? So it's a small, or let's say it's a closely held equity. I would not say small equity. It can be a higher amount of equity as well, but it will be closely held. And it's a private company. Okay, this is called as private equity. Now, venture capital is a form of private equity. Okay, so venture capital is a form of private equity. So public equity we have talked about a lot, right? Because then your shares will be listed on a stock exchange, there will be an IPO, there will be rules around it. Similarly, private equity, if let's say people like us who are retail investors want to invest into a company, they can only do through public equity, right? They can just go and purchase on the stock exchange the shares. But the big investment houses, which are called as venture capitalists, if they want to invest into a business, they can do through private equity. Okay. Perfect. Let's talk about private equity firm. I am taking you through what is the structure of a venture capitalist, right? So this is a private equity firm. These are separate firms, investment firms. These are called as private equity firms. They will float a special purpose vehicle in the form of a trust or LLP. Okay. There is a special purpose vehicle in the form of a trust or LLP. Okay. And in that SPV, there will be pool of funds that will be there. Obviously, their objective is to accumulate funds, and those accumulated funds will then be used to be invested into many businesses, right? So they will invest, they will do an investment, right? Let's say pool of funds is, for example, 100%. Out of that, 5% will come from private equity, and balance 95% will come from investors like banks, financial institutions, pension funds, right? Where they have money to be invested, high net worth individuals, and so on. These individuals who are eager to invest, who are sitting on excess cash, they will actually contribute to 95% of the funds. 5% for investment purposes will also come from the private equity firm, right? Which we are talking about. They will also give the overall governance. Overall governance means what? The overall management of this pool of funds will be done by private equity firm in the form of general partners. They will appoint general partners to this, who are actually the decision makers, right? So these individuals will be appointed as general partners who will make decisions on behalf of this SPV on the pool of funds. These are called as limited partners. Okay, because their liability is limited to the extent what they have paid, right? So they, to the extent the unpaid amount is there, their liability is to that amount, right? Whatever they have paid is the maximum amount of loss that they can incur. Okay, so this pool of funds will then be utilized to target some of the possible companies in which a private equity investment can happen, which are those companies? Those are startups. So they will vouch for different startups. Let's say startup 1, startup 2, startup 3, startup 4, like that. So all these will get their investments from this pool of funds. And for doing this, they will also appoint a manager slash advisor whose role and responsibility will be to recommend journal partners or decision makers about these startups, and hence to get the funds into those startups. Clear? So this is the overall structure of a venture capital firm, or let's say a venture capitalists, right? So there are multiple stakeholders involved. Stakeholder 1 is the private equity firm. Second, general partners appointed to this. Third, limited partners who contribute the amounts to the fund. Fourth, the SPV itself, the new SPV that gets floated. Fifth, the managers and advisors. And sixth, the startups themselves. Right? And let me tell you, students, why they even go for a 5% investment. Because then it brings confidence to the limited partners that they have also invested. If they are going to be the general partners, right? So their investment is also at stake. If they're going to take decisions on our behalf, let's say tomorrow these pool of funds get invested into a company which is not giving a good return, right? Then these limited partners will face a downward, let's say, or not a downward in the investment, but they will not be able to reap out the benefits on the investment as they expect, right? So to safeguard them or to give them a proper, let's say, mitigative risk, so they also tend to invest 5 to 10% of the overall kitty from their own side. Okay. But the management or the governance of this SPV and hence the pool of funds rest with the private equity firms, which are called as general partners. They are all individuals who have the experiences of managing the businesses, different kinds of businesses. And how do they do that? Now, see, the overall objective of a venture capitalist is what? Buy, then grow that business, and then sell the business. You see, there are three things that are happening. They will aggressively grow the business, right? Let's say they decide to invest 1,000 rupees today, right? Through their own interventions, they will grow the business, let's say 7 times in 5 years, 7 to 8 times, or let's say 6 to 7 times, whatever it is. They will not grow the business, let's say 10 to 20%. They have an expectation that the business should be grown through multiple leaps and bounds, which is 6 to 7 times, right? Within a very short span of time. So this will help them in growing through interventions, and then thus they will sell. So let's say 7 times that they have grown, 1,000 rupees they have invested, 7,000 becomes the value of the grown business. They will end up reaping the benefit of 6,000. And from this, they will allocate some money to the limited partners and balance the PE firm will keep with themselves. You see, their overall objective is to buy, grow, and exit also. This generally happens in a time frame of, let's say, 5 to 10 years. So that is why you will see some of the startups will have a very high amount of growth in their own businesses. Why? Because they have a good backing up of a private equity firm, a venture capitalist, whose general partners also get onboarded onto their board of directors. Let me tell you one more thing. A private equity, the way they function is even apart from investments, apart from investing, they will provide governance to startup. One director will be onboarded to board of directors also, and they will even tend to make decisions for startups. They will even do that as well. Okay, they will also tend to make the decisions for the startup to make them grow and aggressively grow the business, right? And because their incentives, or let's say their own stakes, are there into the business with the way they grow the business. Clear? So these are all the pointers for the private equity. I hope you are all now able to understand what is the venture capital doing, what is their functions, and what is their approach in any of the businesses. I hope this chart makes it very clear. Okay, very good. One more thing, this manager or advisor will also take commission. Okay, commission slash salary, whatever it is, for the carrying out their own functions. Okay. Now, next one comes the domestic structure. Now, this is a VC structure, right? So the modes of financing is over till here. This one is over. Now, let's come to the VC structure. Sorry, the domestic structure. So the domestic structure is where everything is within the domestic territory. Let's say the private equity firm, the SPV, the startups, the manager advisors, all of them are there. That is called as the domestic structure. Apart from this, there are two more structures. These are called as offshore structure. Something called as offshore means that some part of it is based outside of India. Okay. One is called as offshore and second is called as unified. So in offshore structure, okay, what happens? SPV is created outside India. Okay. Then there is a manager who is within India. Okay, who's managing the investments, advising on the investments, and the investment also happens in India. You're getting my point. Only SPV is outside India. The SPV is created outside India. In case of a unified structure, the SPV is outside India and there is a pool of funds. There is a pool of funds in which investments happens. Investments from outside India plus the investments will also happen from within India. From inside India. This will be in the form of a trust, right? These pool of funds are within India. And manager is based out of India. So this is what it is, unified structure is. This is offshore structure. And the balance is unified structure, students. Okay. Please do remember venture capital is one form of private equity. Okay. So private equity is a large term. It can have many other aspects, but venture capital is one form of private equity. Perfect. Then comes the characteristics of venture capital. What are the different characteristics of a venture capital? First, they have a long-term horizon, right? They don't have a short term or they don't have a medium term. They have a long-term horizon, that is 3 years to 10 years, in which they will want to invest, grow, and exit. 3 years to 10 years. Second, there is a lack of liquidity. Why? Because they will invest and keep their investments for some time, right? And hence there is a lack of liquidity. Then there is a high risk because they are investing into a high risky ventures which don't have an established way of doing the things. So they might end up having losing their investments also. But at the same time, if the risk is high, the rewards are also very high, which is 7-8 times in 5 years. That is a quite phenomenal way of growing your money, right? Then comes equity participation. So the venture capitalists can invest into the equity, right? And hence the equity participation becomes one of the key characteristic of a venture capitalists, right? Perfect. Let me just open the study material and see. Yes. So let's come from the beginning. So startups we discussed, innovative ways to finance the startup we discussed, pitch presentation also we discussed, right? What all things to be included. Unicorn, what is the concept we discussed? Then there are some of the examples given of unicorn that can be read through. Modes of financing for startup, we discussed about bootstrapping. No, I'm not sharing it. I'm just trying to tally what all topics are left. Angel investors we discussed, students. Venture capital fund also we discussed. Now comes the advantages of bringing the VC in the company. So what are the advantages of bringing the venture capitalists? So I think some of the advantages we already discussed, right? So the biggest advantage is that you get a long-term equity, right? You get a long-term equity because you're getting an investment for long-term purposes. The venture capitalist also becomes the business partner, right? Why? Because they are also invested into the business and hence they share all the risk and rewards. So they are the business partner to the business. Then they also are able to provide the practical advice and assistance, right, with their all experiences that they had with the other companies in the similar situations. That is, I told you, right, they will act as a director of the company. They also have different connects or contacts using which they can make use of some of the specialized things that are used in the company, and they can prove to be a value addition in the entire process. Plus one more thing, they can also provide additional rounds of funding. Even in this is something that we missed. So what happens in case of venture capitalists, they can also provide you with the extra round of funding, let's say round 1, round 2, round 3, right? There are different stages that also we will discuss. Additional round of funding. And then lastly, they can also help in preparing for IPO, right? Because they have done it in past for the other companies, right? And they can also facilitate for a trade sale. Okay, that means sale of the business or sale of their stake. Okay, now there are different stages of funding for VCs. Stages for funding a VC. The first one is called as seed money. Okay, so the seed money is the level at which you just need to provide or to fund a new idea. That low level of funding is called as seed money. Then startup. Now in this case, your idea has been taken up to the next level, and for the associated, let's say, the development of that idea into a product, or let's say marketing of that idea, you need expenses. For those expenses, the funding that comes into the startup stage of the funding. Okay, this is again pre your commercial activities. Then the first round generally happens once you start your commercial operations. That means your early sales and manufacturing rounds will happen in the first round, right? Then slowly, gradually, you will ramp up your production and sales, but you have still not become profitable. Then the second round will come to sustain that level of funding, right? Then third round Third round will called as, it is also called as mezzanine financing. Mezzanine means in between financing. So this is basically when you are getting into a profitable company, right? For that, the expansion money that you need, that is called as third round. And fourth round is basically bridging the finance. It's called as the bridge financing, wherein before going public, you will need finance. So this is for the bridging that financing gap, students. Okay, so this is the fourth round of funding. Okay. Perfect. Then will come, I think these are all part we have covered. Now let's come to the succession planning of businesses. No, I think wait, before this, the sequence of venture capital is what we have discussed in brief, but let's cover that in detail. Just a second. Yes, VC investment process. We will call this as VC investment process. So what happens here? First of all, a deal gets originated. Deal origination. Okay. Deal origination is a stage where VC, the venture capitalist, is basically trying, before sourcing the deal, that which sector we need to focus, right? Is there a specific promoter focus? Is there a specific turnover focus, right? Here the company would give a detailed business plan which consists of the business model, financial plan and exit plan, right? These are all covered in a document which is called as the investment memorandum. This is a very important document that comes in the overall first part of the VC investment process, which is called as deal origination, students, right? After the deal origination has happened, then the screening will happen, right? So the VCs will screen all these applications. These are some of the committees that they develop, right? As I said you, there will be some general partners who are appointed. So they will do the screening of such applications. After screening, there will be due diligence carried out. So due diligence is basically some form of assurance that the company in which you are going to invest is basically performing the levels at which it is mentioned, let's say in some of their reports, in some of their financial statements, whether those looks okay from an overall operational perspective. Then comes deal structuring. So deal structuring will mean that what percentage of equity will be bought at what price, whether it will be in the form of equity, convertible loan, convertible debentures, or how. So this is basically the structuring of the deal, and for how many years it will be provided. Apart from the financial aspects, what are the other non-financial aspects that will be dealt in? So these all will be part of the deal structuring. Then comes post investment activity. Now, after your investment, you will also monitor how the investment is faring out, right? So in this, it will be periodically keeping the VCs about the updated milestones from the business side, the VCs getting into the business, and then finally an exit plan, right? Wherein you will exit the venture capital, or let's say the private equity, in a way and form which actually helps you to reap out the benefits. Okay. This is a VC investment process in India. Now let's come to the succession planning. So students, first of all, what do we mean by succession planning? So succession planning of businesses means that you have an identified you have an identified individual to take over in case the person who is currently performing the job is, let's say, is not there due to death, natural cases, or maybe let's say some sort of an injury or some sort of a cause removal, right? So there can be different ways for which a person cannot perform the current roles. So let's try to understand that why there is a need for succession planning. One, risk mitigation, right? Risk of that the business will continue without any leader, right? Or let's say the specific targeted roles which are very important for the company will be there without any person being supporting to it. So there is a risk to it. So one, we would want a risk mitigation to happen. Second, if there is a cause removal, cause removal means that a person has done some non-compliance, or let's say some acts have happened in contravention to some of the laws which will make that person to be removed from that position. Let's say the board of directors of the company secretary, the CFO, right? If let's say those positions are getting removed, so those are called as cause removal because of some of the non-compliances to any of the requirements, right? So in case that happens, then you need quickly another person to step in and perform those duties. Then there is a interesting case for talent pipeline, because you will still want to build your talent pipeline. You would want to assess who are the right people in the talent who can willingly take up this job, right? Then there is a conflict resolution mechanism. So this act for that, because for a single position there will be different people who will be targeting to take up, right? So through a proper succession planning you can resolve the conflicts between all of them. And then aligning, so basically aligning the long term goals of an individual into that company with the availability of the opportunities that are there. Okay, so this is why a succession planning should be performed for all the businesses in India, right? And in this, we should first of all identify the top key leadership positions. So this we call as business succession strategy. Okay, so this is about evaluating key leadership position. First, we need to identify that which are the key leadership positions without whom the business, or let's say the function, might not exist, right? Then we will have to map competency for above position. That means what all competencies are required, right? What all skill set is required to perform duties for this key leadership position. Then what we will do, we will identify that what is the competency of current workforce. Where are these currently placed in terms of the competencies that they can offer? What is the available thing, right? And then you also need to think about a bridge leader. Let's say a leader who can act as a leader for, let's say, 6, 7, 8 months till the time a final leader comes in, right? Because there might be some situations wherein you might need a bridge leader as well. Then let's also talk about some of the challenges of succession planning. So in terms of challenges of succession planning, what happens is there is always a founder mindset. If we talk about startup, right? In case of a startup, the face of the startup is the founder itself. Just a second. Okay. So it would be very difficult to identify, or let's say to do a succession planning for the founder position of a startup, right? Because they are actually the brain of that startup. Okay. Then, second, for startups, it will be a premature activity because it will involve time, cost, and efforts. Premature for startups, right? It can be a kind of premature activity because they will want to scale up their own businesses rather than putting some of the cost and efforts to it. But at the same time, they should do it for some of the key other positions, because in case, let's say, they have already identified an individual who can take up from the business succession standpoint, they can just do plug and play and accordingly complete the overall part, right? Then this is something that we have already discussed, that founders are face of startup, and hence it would be difficult for you to imagine a succession planning for a founder. So this founder mindset means that founder's brain will basically define how that startup works, because they had an idea initially, right? And for putting that idea into force, they have got the resources together, right? So that is where the challenge lies of doing a succession planning for a startup. Are things clear, students? Yes, business continuity planning, Saminathan, you're right. Perfect. So this was all about the startup finance as well. In case you have any questions, please do let me know. If I just sum up, see, the entire startup finance is based on a premise that the structured form of financing available for the startup is very low. Reason being, you have entered into a new business. The possibility of succeeding into that business is very low, and hence banks generally don't give startups a good lucrative investment opportunity. As a result, they have to find their sources of funding within the company, within their networks, within their contacts, within some of the innovative ways to finance startup, for example, a crowdfunding, right? And obviously, once their, let's say, business is at some stage, then definitely using the venture capitalist form of funding, because that is also regarded as one of the good ways of funding. Now, venture capitalist, there is a separate structure to it, right? There is a separate private equity firm which keeps on investing into that business, right? And the ultimate objective is to grow it multifold and then exit it at a right time. Okay. Now, students, let's come to the different parts of the MCQs. Now, I want all of you to please answer this, and please put your answers in the chat box. Don't say it out loud so that the rest of all of you can answer. And I expect all of you to answer this, please, so that we can finally sum the today's up session. Okay. Question number 1, students. In dash mergers, the acquirer and target companies are related through basic technologies, production process, or markets. Is it horizontal merger? Is it vertical merger? Is it conglomerate merger or co-generic merger? So we can always say horizontal was between the same industry, right? Vertical was forward and backward integration, buyer-seller relationship. conglomerate, two unrelated business, and generic merger, something in common, right? So what is the right answer, students? 1A, B, C, or D? Come on, students. Okay, one answer has come. No, A is not the right answer. The correct answer here is D, because they are related through basic technologies, production process, or markets. They're not exactly belonging to the same market. Okay. Then question number 2. A dash is the sale of an asset, factory, division, product line, or subsidiary by one entity to another for purchase consideration payable either in cash or in the form of securities. Sell off, partial sell off, spin off, split up, equity carve out. Come on, students. What is this process called where you just outrightly sell these assets, factory, division, product line, or something to A? Very good. Sell off or partial sell off is the right answer. It's not a spin off because you're not incorporating a new company within the same group. It's not a split up. It's not a equity carve out, right? It's a sell off. Then third question, students. An acquisition of a company or a division of another company which is financed entirely or partially using borrowed funds is termed as. So you are using borrowed funds, right? This was management buyout. This is going private, equity buyback, and leveraged buyout. Come on, students. Today only we discussed if you borrow the funds and use it for the acquisition of a business, it is called as what? No, let's just check. It's not going private definitely because going private means you are repurchasing. Yes, Sanjay, you are right. Leela, you are also correct. It's called as leveraged buyout. Very good. Then, fourth, the main objective of Dash is to raise money despite not having any operations or revenues. The money raised from public is kept in an escrow account which can be accessed while making an acquisition. Come on, students. Today, just now we discussed some time back. This is called as which companies? Private limited companies, reverse merger, management buyout, or special purpose acquisition companies. Yes, very good, Saminathan. Your answer is correct. Yes, 3D and 4D, both of them D. Yes, special purpose acquisition companies, right? Because these are called as blank check companies. The operation has not yet started. Question number 5. Dash is the form of financing in which a company lends money to one of its customers so that he can buy products from the company itself. Is it personal financing, customer financing, or what, students? Yes, very good, Leela and Saminathan. You are correct. It's customer financing, right? Then, which of the following is not a precondition for qualifying as a startup as per the notification released by Government of India? Incorporated 10 years, turnover 100 crores, publicly listed companies and innovation of product or processes. Come on, students. Sixth part, a very easy one. Yes, sixth C, a publicly listed company is not allowed to be a startup because that company can actually is already a very scaled up company. Yes, Saminathan, your answer is right. So C is the correct answer. It cannot be a publicly listed company. It has to be privately held in the form of a private company, or it has to be a registered partnership firm or a limited liability partnership firm. So, students, with this, now we have completed the overall part of mergers and acquisitions and startup financing. It was a great experience from my end to interact with all of you and take all of you through some of the concepts on advanced financial management. Ashish sir is, I think, in a meeting. He won't be able to join us today for the concluding remarks. So I'll try to end on behalf of him, on behalf of entire board of studies. We want to express all of you a great amount of thank you, and we wish all of you all the very best for your examinations. Please study well, revise well, and appear well for your examinations and come out with flying colors. At the same time, we would like to thank some of the individual students who have been really engaging throughout the entire sessions. I think initially Chitra, Prithviraj, and Geet Chauhan were the students who were very active initially, and then later on who are not part of the sessions in the live classes, but I'm pretty sure that they would be listening, hearing, and attending these sessions. At the same time, the current set of students who are here, Saminathan, Sanjay Haku, Bibu Pandey, and Leela, and to all the other individuals whom I might have missed while announcing their names, we thank all of you a lot because of you all. I mean, the class looks like a class. Yeah. So I would say all the very best. In case you have any queries while preparation of your examination, you can reach out to the number and the email ID, which I'm just flashing it out. Just give me a moment. And in case anyone would want to share any thoughts or any queries, you are feel free to do that. Just trying to find out. 5, no, after 5. Yeah. This is the phone number and the email ID, students, wherein you can connect. See, Ashish sir would be there, and yeah, you can ask any of the queries while it is there. Yeah. Yes, Aminathan.
Sir, thank you so much, sir. Your dedication and your disciplined way of approaching us, and your experience, knowledge, and skills, and your conceptual clarity, and in all the ways you have explained in detailed way, and wherever the doubt, even a small or silly doubt, you are able to answer to us. It's really helped us to understand the subject in detailed way, sir. Definitely, your seed is very great seed. Based on this seed, definitely we will put some water, and we will
I'm sure.
definitely will grow in the future life. We will remember you always. Thank you so
Oh,
much, sir. Your dedication.
thanks a lot to all of you because I mean, it's my duty to make sure that all of you have zero doubts in your mind while you study. And yeah, the conceptual clarity should be at our base, whether it is advanced financial management or any other subject. Conceptually, we should be clear, at least in the first set of time when we are studying the subject. Then, obviously, it has to be coupled with many of the revisions before we finally appear for the exam. And I would say all the best to all of you. And thanks a lot, Saminathan, for your kind words. Thank you.
Thank you, sir. In fact, we are blessed because you are the blessing for us. Thank you.
No, not at all. Not at all. Yeah. Thanks a lot, Sanjay. Thanks a lot, Leela. Thank you all. Thank you, Saminathan. Thank you. So let's close out the session for today. and I wish all of you come out with flying colors in your examination. All the best. Session over.